Well, good afternoon. I want to thank everyone that's joining us today as we do our quarterly economic update. For those of you that have participated before, you know that you're going to get a lot of information about the economy. We're going to talk a little bit about how that's driving the markets, and then really forward looking what's on the horizon as far as the rest of this year. Everyone will be in a listen-only mode, so if you have questions, please put them in the Q&A box that's in the bottom middle of your screen. We definitely encourage you to ask questions as we go. Our speaker today is very enthusiastic about all of the information that he has to share, and the more interactive that it can be, the better. Before I introduce him, I did want to just let you know of a couple of events that we have coming up next Wednesday at our office. We're having a shred event. So for all of you that collected your tax documents, any other papers that you maybe don't need anymore and are looking for a secure way to dispose of them, you can bring that by all day on Wednesday. And then next month, we're going to be having Social Security as our educational topic for our webinar. So be on the lookout for more information about that in our monthly newsletter. Now, on to the bulk of the conversation today. I'm really excited to be joined by Dean Goldman. He's a certified financial analyst, Chief Investment Officer of Cetera Financial Group and Cetera Investment Management. And he really spends all of his time overseeing the day-to-day research and economic outlook for Cetera, who's our broker-dealer. He spends a lot of time speaking on this to his internal team, to advisors like myself, and to the public. So you may have seen him on one of the broadcasts that you watch that has financial information or updates. I've seen him on CNBC, Fox Business News, and he's also frequently quoted in a bunch of other periodicals. So with that, I'm going to turn it over to Gene and have him share what we're looking at as far as the state of the economy.
Sounds good. And Lindsey, thank you. Thank you for the introduction. And I was excited when you said shred event. I was thinking that was like a big workout event or something. I didn't realize the other shred event. So thank you, Lindsey. Thank you so much. Let me share my screen. And as I'm doing that, I'm not, as you know, I'm not very tech savvy, so it might give me a few seconds. So listen, first of all, Lindsey, thank you so much. And thank you for the introduction. Just by means of background, I have been with Cetera, and Cetera is the broker-dealer that Lindsey's affiliated with for 13 years. And then before that, I was in Boston. So I live in California now. Before I was in Boston, I was at another broker-dealer for 16 years. And before that, another one for 2 years. And then before that, I was in grad school in Boston. And then before that, I went to engineering school just outside Boston. So I'm an East Coaster, but I love the West Coast, and I love the warm greetings. And really, it's so wonderful being here on the West Coast. So with that said, I'm going to talk for maybe about 25 to 30 minutes. And what I'll do today is I'm going to talk about our 3 investment themes for the rest of this year. And they have a slight positive bias. But with that said, though, I'm going to really take a step back and interweave those themes into what's going on in the markets and the economy right now. And really, the gist of it is that we feel a lot of good news is coming. But the problem is that a lot of this good news has already been priced into the market. A lot of great news, a lot of great things are going to happen, but a lot of it is priced in. So really, in a nutshell, I'll talk about some concerns that we have, but then there's light at the end of the tunnel. So let me dive right in. And I'm calling this presentation, Equities May Need a Little Bit of a Breather. And let me explain this. So if I go to this next slide. So as a reminder, we laid out 3 themes for this year. And so at the beginning of the year, we said this is what was going to happen for the economy and the markets. Number 1 was that the Fed goes from being a foe to a friend. And what that means is that the Fed goes from raising interest rates to cutting interest rates. Just to take a step back, as we all know, the Fed, the Federal Reserve, they're in charge of monetary policy, and they have a dual mandate. So what that means is that if they think inflation is too high, they raise interest rates like they have been doing for the last 2+ years. If they think the economy is going too slowly and that we're losing jobs and they're worried about where the economy is headed, they lower interest rates. And what happens is when they lower interest rates, mortgage rates come down, auto loan rates come down, and this in theory stimulates the economy. The Fed does a lot of stuff, but those are their primary tools. What they do is that they raise and they lower what's called the Fed funds rate. So our first theme is that the Fed goes from being a foe. They go from raising rates as they did last year to cutting rates this year. I know there's some talk lately about maybe they won't cut rates. We'll come back to that in a second, because I still think they're going to cut rates. The second theme is that the economy cools into a soft landing. So what that means is just a fancy way of saying we don't see a recession this year or probably for the next 12 months. And I think more importantly, though, is that even if we have a recession, even if a recession happens, it's going to be so very mild at the worst case scenario. And I'll talk about that in a second. And then our third theme is that market volatility is going to increase. This is where I'll spend most of my time today. Market volatility is going to increase because there's lots of good news, lots of bad news, but we don't know which way the markets are going. There's so much uncertainty. Case in point, yesterday, we saw an inflation report, the consumer price index. So it's inflation for you and I as consumers. It was well above expectations. But then today, another inflation report, the PPI, the producer price index, came in below expectations. So you have all this together. There's a lot of uncertainty. What does this mean? We do think this will lead to a market pullback. We do think stocks are going to weaken a little bit. But the good news is that any pullback, any weakness, any correction is likely to be very short-lived because we have a lot of great fundamentals. So therefore, the actionable investment advice for that third point is that take advantage of any potential market pullbacks or dips because we foresee any type of pullback will be very short-lived. So these are the three big themes we have. But let me kind of talk about today, and I'm going to weave in these themes into my comments. So if you look at today, I'm a big fan of reading and books. And as a kid, one of my favorite books was Goldilocks and the Three Bears. And if you think about that, Goldilocks, she goes into this house, this cabin, and she's like, oh, this porridge is hot, this porridge is cold, and this porridge is just right. We think we're in a Goldilocks economy where things are not too strong, not too weak, but things are really perfect on both the economic front and the inflation front. So let me talk about this for a second. So how do we know the economy is doing okay? Well, if you look at this slide, this is a slide, it shows what's called the Citi Economic Surprise Index. And Citi, not a city, but Citi, CITI. And what it is that every time a data point comes in above expectations, like an economic data point, like payrolls or like jobs or like manufacturing, every time a data point comes in above expectations, the line moves higher. Every time it misses expectations, the line moves lower. Look on the far right-hand side. The data is getting better and better and better. It's exceeding expectations. Why do we care about this? Well, because if the data gets better, in theory, companies sell more stuff. If they sell more stuff, they generate more earnings. If they generate more earnings, this in theory, increases the value of their share price. And in theory, investors like to buy those shares. So there's a lot of assumptions in there, but basically a stronger economy is good for the markets. And you see here, the economy is getting better. What's driving a lot of this is something that we've been thinking about for a while, is that we think our economy may have had a recession already. It was very mild. But at the end of the day, if we had a recession or we are in one or we're headed to one, we think it's going to be extremely mild. And the reason we kind of portray this scenario is because we think we're in what's called a sector recession or even a sector rotation. So again, maybe we had a recession because some of the data suggested maybe it got weaker. Maybe we have one coming ahead, but it's going to be very weak if we have one. Or maybe we don't have a recession. But either way, it's a really good economic environment. Why is that the case? Because again, it's this whole concept of a sector rotation, a sector recession. So let me talk about this, what sector means. So let's say that, in our opinion, a sector recession is a recession where some sectors of the economy are weaker, some are really strong. And what happens is that as the economy progresses, the weaker sectors start to improve a bit, and the strong ones start to weaken. The net effect is that you have a very mild recession. So not like a nasty 2008 where everything fell at once, where you have a narrow, thin type of recession. So let's talk about this in terms of today. What's today? So today, what's in recession? Housing and manufacturing. You've seen housing prices with mortgage rates so high. Housing has been in recession. Also, another area in recession is manufacturing. So manufacturing has been in recession for 15 straight months. So these areas are weakening, but we're starting to see a little bit of improvement. If you look at this slide, and my slides are organized pretty much in the same manner. The horizontal axis is time, and the vertical axis of plotting a data point. So here I show two data points. The light blue line is building permits. And this is a forward-looking indicator for housing, because basically if you're a builder, you want to build a house, you have to file a permit. So if you look at the light blue line, building permits, remember the area in recession, building permits are up 33% year over year. So housing is in recession, but it's starting to stabilize and improve. The other area in recession, manufacturing. Manufacturing has been in recession for 15 straight months. But if you look at that dark purple line on the right-hand side where those arrows are, that's manufacturing new orders. It's a very forward-looking indicator, just like building permits. Very forward-looking indicator. Manufacturing new orders are also rising. So the key point here is that those areas in recession are stabilizing and getting slowly better. The areas that are not in recession is the consumer. The consumer is not in recession. You and I, we're seeing people spend money like crazy. People are going to hotels, vacations, buying stuff. People are spending money like crazy. But the consumer, this area up here, remember, the weak area is the strong area. This strong area is starting to weaken a bit. Why? We've got student loan repayment. We have high credit card debt. Think about this. We have $1.4 trillion of credit card debt. Our overall economy is 28 trillion. 1.4 trillion is credit card debt. And some people are, and that's a record, first of all. Second of all, some people are paying over 30% in interest rate on credit card debt. That's going to impact the consumer. Plus, you see high prices, you see high interest rates. All this stuff is going to impact the consumer. But the good news is that the consumer, as you and I weaken a bit, we are coming off of a very strong foundation, and we don't think we'll weaken that much. Why is that the case? If you look at this chart shows that the labor market is very strong. So one thing I plotted, well, first of all, you can look at many ways for the labor market. You can look at jobless claims, so how many people file for unemployment claims in a week. It's about 215,000. It's a very low number. Or you can look at the unemployment rate. We've had an unemployment rate be below 4% for 26 straight months. We have not had it that long since the 1960s. The employment picture is really strong. So therefore, the consumer will definitely weaken, but not weaken too much because we have a very strong labor market. You look at this slide. This slide, what it shows the number of jobs out there divided by the number of people looking for jobs. Today, the ratio is 1.38. So there's 1.38 jobs for everyone looking for a job. So anyone that wants a job can find a job out there. Even people that don't want jobs can find jobs. There are so many jobs out there. Strong labor market is good for the consumer. Consumer will weaken a bit. You and I are going to weaken a bit, but we're coming off of a very strong foundation. Another thing to think about is just debt. So if you look at debt to income. So the Fed, remember the Fed raising rates and lowering rates? The Fed raised rates from 0 to 5 3/8. Say 5 3/8. And when they raise rates, interest rates move higher, borrowing costs move higher, home equity loans move higher. Despite the fact the Fed has raised rates from 0 to 5 3/8, debt to income has been pretty flat. This chart shows debt, consumer debt divided by consumer income. It's been pretty flat around 10%. So despite the fact that interest rates are moving higher, we as a consumer are in a great place. We have low debt to income. Very, very, very good news. As a side point, look at that big gray bar in the middle, and those gray bars represent recessions. That was the 2008 recession. Look at how much debt we had relative to income. See it rising up? We are in much lower perspective right now. So why is that the case? Why are we so much lower in debt? This slide kind of explains it perfectly. If you think about mortgages today, right now about 90% of mortgages are 30-year or 15-year fixed. So even with the Fed raising rates, pushing mortgage rates to like around 7%, the average mortgage rate on an existing home today is about 3.8%. So despite the fact the Fed is raising rates to slow the economy down and mortgage rates are moving high, which in theory puts more debt on our balance sheets, on our personal balance sheets, the key point here is that really most of our mortgages are fixed mortgages. So despite the fact the Fed is raising rates, putting upward pressure on mortgage rates, our average rate is still pretty low. So again, overall, we think the consumer is going to be pretty strong. So if you think, again, going back to this analogy, these areas of the economy are in recession, these areas are not. We do think these areas are starting to strengthen. We're seeing data on this. The consumer will weaken. So what I'm trying to say is that even if we have a recession, which we don't think there will be, even if there's a recession within the next 12 months, it's going to be so mild, we probably won't even feel it. And if you look at this chart, I think this chart kind of explains it perfectly. This is from the government. This is from the Fed, excuse me. The Fed produces a daily estimate of GDP, and GDP is our economic output. Lots of stuff going on here. The key point, look at the red arrow. Based on estimates, the Fed thinks that GDP for the first quarter, so the quarter that we just ended last quarter, will be up about 2.8%. pretty far away from a recession. Remember, a recession in theory is when the economy goes below zero. Far from a recession right now. So again, the economy is very strong. So the overall takeaway, the economy is in a great spot. It's just perfectly, it's moving along. It's in that Goldilocks perspective. The other area that's in Goldilocks is just inflation. So if you go back to COVID and the COVID times, what happened is that, you and I, we stayed home. We ended up buying a lot of stuff, buying a lot of goods, buying refrigerators, TVs, whatever people bought. Put a lot of pressure on goods. Goods prices surged. And we had some supply chain issues. We also had a surge in inflation because of the Russian invasion of Ukraine. All these taken together pushed an upward surge on inflation. So the Fed, to address this, they raised interest rates. Remember, I talked about their dual mandate. They raised interest rates to slow down the economy, which in theory would slow down inflation. So if you look at this chart plots what's called core PCE. So core PCE is another inflation measure. I think there's like thousands of inflation measures, but why is this one so important? This is the Fed's preferred measure of inflation. Basically because some of the other inflation measures have too much overweights of different components of the economy. This one is their preferred measure because it's much more of a uniform measure of inflation. So core PCE. If you look on the right-hand side where I put the arrow, core PCE, whether you look at the last 1 year, 6 months, 3 months, it's rolling over pretty fast. Right now we're around low threes, high twos. Just a few years ago, we were around 6 or 7%. And remember, the Fed's target is to get core PCE at 2%. So overall, inflation is rolling over pretty fast. There's some choppiness lately, and I'll talk about that in a second. But overall, it's rolling over pretty quickly. Why do we care? Because if inflation rolls over, this in theory suggests that the Fed will go from raising rates to cutting rates. And we still think the Fed will cut rates. But let's take a step back. The last, say, couple of weeks, there's been a lot of talk out there that maybe the Fed won't cut interest rates in 2024. And there's two reasons why. And I'll talk about why those reasons exist, but more importantly, why we don't believe in the validity of those. So number one, the first reason why the market is saying, oh, maybe the Fed won't cut rates this year is that services inflation is pretty high. So if you look at this chart, what I did is I took inflation and I broke it out into two pieces, goods inflation and services inflation. Goods inflation is that dark purple line, and you look year over year, it's negative. It's below zero. So there's really no inflation for goods. Goods inflation is coming down. It's negative. That light blue line is very important. That's services inflation. That's inflation for going to see a plumber, electrician, healthcare, all the services, leisure travel, all the services economy. And services inflation is pretty high at close to 4%. But the good news is that if you look at a lot of the recent measures in terms of services, in terms of services hiring, services is slowing down pretty quickly. In fact, services every month has gotten weaker and weaker since November of 2021. You may not feel it because you're seeing people spend money like crazy on airplanes, on hotels, on flights, but services is slowing down. And we do expect this will start to put pressure on services inflation, the weakness. Also, as the Fed is raising rates, as the Fed is keeping rates high, they've also put pressure on the labor market, and the primary component of services inflation is labor. So that's the first reason why the Fed, people are saying the Fed may not cut rates this year. We still think they will because services inflation, while it's high, it's coming down. The other reason why people are saying, hey, the Fed may not cut rates this year is because we've seen a bump up in inflation over the last couple of months. So we do think that bump up in inflation is an aberration. It's some bad data points. It's a very temporary choppiness. And let me explain why. If you look at this chart, and this is a lot on this chart, so let's just bear with me for a second. So let's go back to January of this year. And in January, we got the January CPI, the January Consumer Price Index report in the middle of February. And if you go back in time, what happened is that the January CPI came in at 3.1%. The market expected 2.9%. So inflation was stronger, was hotter than expected. This caused markets to sell off. But if you decompose why that inflation came in above expectations, there was one component why it came above expectations. It was this. It was owner's equivalent rent. And if you look at this chart shows two things. The purple bar is owner's equivalent rent. The light blue is rent of primary residence. So both measures of basically rent. There's slightly differences, but both measures of rent. and rent inflation. If you look month by month by month, these two are highly correlated. But then in the month of January, where we circled it, we had this big aberration, this unexpected, this bad data point because an owner's equivalent rent, it surged. It does not make sense. It was an aberration. It was a bad data point, in our opinion. And if you look at the next month, February and March, it's come down. So this data point really freaked out market participants because they're like, oh, inflation is surging again. Watch out. Fed's not going to cut rates. We think it was a very, very bad data point. We do think rent is slowing down pretty fast. In fact, if you look at this slide, well, I think it's interesting. There's two lines here. The purple line is CPI, remember, Consumer Price Index, excluding shelter. So right now it's about 2.3%. So you take out rent inflation, it's down about 2.3%. It's good. It's getting close to that Fed's 2% target. But look at the light blue line where I put the arrow. That's shelter inflation, and it's rolling over. It's still pretty high. And if you go back to 2016, 2015, it's been flat around 3% or so. It's still high today, around 5.8 to 6%, but it's coming down fast. And here's the best thing about this. Look at this next slide. Think about this, okay? Over the last 12 months, rent inflation, remember the owner's equivalent rent, that shelter inflation, was up 5.8% year over year. That's pretty high, but it's a very backward-looking indicator. Let's instead look at rent in terms of a forward-looking indicator. And one of the best forward-looking indicators for rent out there is basically asking rent. And asking rent is when we go to websites like apartments.com or Redfin, wherever you want to go, and you pull the data in terms of what new properties are being listed from a rent standpoint. And it's a very forward-looking indicator. So think about this. In the last 12 months, CPI shelter or CPI rent was up 5.8%, backward-looking indicator. A forward-looking indicator, asking rent was down 1% year over year. Asking rent leads rent by about 3 to 6 months. So all we're saying is that this elevated level of inflation recently, this choppiness, we think it's going to be very short-lived. It's rolling over pretty quickly, and asking rent suggests that rent is going to roll over, which should help inflation. So long story short, what we're saying is that we still believe the Fed will cut rates. We still believe inflation is rolling over. It's just a little choppiness lately. And then if you look at this chart shows the probability of the Fed cutting rates. So, what I'll explain, if you look at, let's pick September. So September in the middle, 69.3%. The market is saying there's a 69% chance that the Fed will cut rates in the September meeting. The cut rates once in September meeting. It's good news, okay? So again, there's a lot of uncertainty right now in terms of when the Fed will cut rates or if they'll cut rates. But at the end of the day, we think they will cut rates because inflation is rolling over, because the markets are suggesting it. And also think about this last point. It takes about 12 to 15 months for a rate hike to be fully felt by the economy. Remember, we raised rates through July of last year. We still have a ways to go to feel the full effect of rate hikes on their economy. And the Fed is very cognizant of this because they know if they keep interest rates high, then it pressures the real estate market. If the real estate market is pressured, then the banks get pressured. So it's this big spiral effect. So long story short, as I kind of wind down this section, is that the economy is in this perfect Goldilocks scenario, not too hot, not too cold. Inflation is a little bit hot lately, but it's rolling over. Again, it's a good spot. So there's lots of enthusiasm and optimism about the economy and inflation in the markets. And this is why, for example, the stock market since October 27th of last year, that correction low, we'll talk about this in a second, since that correction low is up about 28%. Stock market has gone like this in the last, say, 6 months. It's a big jump. So this ties into my second section. My second section is, yes, there's lots of good news out there, lots of great news, but maybe there's too much optimism around investors. Maybe investors are just too optimistic right now. And we think they may be a little bit too optimistic. So let me explain. So if you take a step back, we talked about this. The S&P 500, remember the S&P 500 is that broad stock market benchmark. If you look at this chart and that dark purple line that shows the index going up and down, look at the red arrow. Since October 27th of last year, the stock market has gone straight up 28% in about 6 months. If you took that and made that over a full year, just simple math, compounding, that suggests that the stock market is up over a full year, up 56%. That's a huge, huge run. The problem is that when you have a huge run, you have just a lot more risks because, again, stocks don't travel straight up in the air. They do take breaks, they do take breathers. But the problem is, the point here is that everyone's so optimistic about the economy, about inflation, rightfully so. But again, maybe they're a little too optimistic. Another way to look at this optimism, look at this slide. This slide, lots of like lines here and there, but look at what this line shows, these blue lines. It's basically a sentiment indicator. So what it does, it takes the number of people that are bullish, people that are super optimistic, bulls, and they subtract out the people that are bearish, people that are just like, I hate the market, it's going down. They take the bulls, they subtract the bears, and the higher that number is, that means there's a lot more people bullish than bearish. See the red circle? There are a lot more people out there so excited about the market and so optimistic. So much optimism. So you've got the fact the stock market is up 28% since October 27th. You have the fact that everyone is so bullish on it. Even my mom is bullish. My mom calls me and she's like, oh, I hear about these stocks. She wants to buy stocks now because they've moved up so much. There is so much bullishness out there. When you have so much bullishness out there, you increase risks and there's more risks in the market. And let me talk about some of these risks in the market. So here are the 4 risks that we're watching carefully. Number 1 is that maybe the Fed waits too long to cut interest rates. Maybe something is going on behind the scenes and the Fed will need to cut rates quickly. You could look at the banking crisis in March of last year. You could look at just uncertainty. If you look at the consumer today, you and I, the lower income consumers are struggling. Oil prices are higher, gas prices are higher. This is impacting lower incomes really quickly. Maybe the Fed waits too long to cut rates and pushes us into a recession. Another risk is number 2 is that the Fed cuts rates too soon. And all of a sudden inflation surges. Go back to remember the 70s and the early 80s. In the late 70s and early 80s, what happened is that under Paul Volcker, inflation was surging. So Paul Volcker comes in, the head of the Fed back then. He's like the Jay Powell, but back then. He comes in, he raises interest rates, and this slows down inflation. Then he cuts interest rates, and then all of a sudden inflation came back again. He had this big double peak, huge volatility in the stock market. There's always a risk that the Fed cuts rates too soon. Third risk we're watching carefully is that there's a lot of geopolitical risks. You've got the Middle East war, you've got the Russia-Ukraine war, you've got issues around Taiwan, you've got the Houthi rebels, you've got the fact that the Panama Canal is getting more shallow, you got the fact that the Rhine River is drying up a bit. All these risks out there are putting pressure on, are creating uncertainty. And the last point I really want to focus on, frothy large cap valuations. Frothy, I'm not sure why I said frothy, but just high valuations. And let me talk about that for a second. So you look at this chart, and this chart shows the PE ratio of the S&P 500. So just to take a step back, PE ratio is price to earnings ratio. So what this is a measurement of valuation. A higher PE ratio, stocks are more expensive. Lower, they're cheaper. And PE stands for the price of the index divided by earnings of the index. So price earnings. If the PE ratio is high, it's expensive, low is cheaper. Look today, the PE ratio in the stock market is around 21. The average is around 18. The stock market has a higher valuation than the long-term average. So you can have high valuations. It has happened before when you have low interest rates and when you have low inflation. Well, inflation is still pretty high and interest rates have been moving higher lately. This suggests to us that the markets are pricing in absolute perfection. Everything needs to be exactly perfect. No concerns about inflation, no weakness in the economy, nothing, because the stock market is pricing in absolute perfection. All this is such perfection right now. But again, there are more risks. You've got the Fed. You look in this chart. So what the Fed, again, they're in charge of monetary policy. The Fed has some newer voting members, and these are the newest voting members. It's Mary Daly, Bostic, Barkin, Mester. And you read some of their comments. Some of their comments recently are talking about uncertainty about interest rates. Like, let me just pick on, I'll pick on Barkin. So Barkin is the third from the top. He says a real risk that there will be continued inflation pressure. These are cautious tones. So maybe the Fed doesn't cut rates as people anticipate. We still think they will, but this adds another risk to the overall market. And then you look at interest rate. Look at the 2-year Treasury yield. Interest rates, that red arrow, So the interest rate is that blue line, and the red arrow shows where it's going. Interest rates since January have gone for the 2-year, gone from 4.2% to 4.8%. And actually today it's at 4.97%. What do we care? Why do we care about interest rates moving higher? Because interest rates therefore means higher borrowing costs. It becomes more expensive to service debt. Companies borrow money, it becomes more expensive for them to borrow money. It's a big, snowball effect. But basically, higher interest rates, higher yields equals higher interest rates and higher borrowing costs. Again, this is the risk. Another risk is oil. Look at oil. Oil has gone from around, below $70 a barrel in December, now to about $85, $86 per barrel. That's a big jump in oil. That's a big risk to the economy because higher oil means higher gas prices. That means more expensive to fill our gas tanks. All this taken together is just another risk. So what I'm saying is in the second part of what I talked about is that there's lots of good news out there, but the markets have priced in all this good news, in our opinion, and they've priced in so much optimism. With valuations so high, there's lots of risks in the market. And what does this mean? We do think that there will be a pullback. There could be a correction, and correction, keep in mind, correction sounds scary. And the correction is when the stock market falls more than 10%. But corrections happen on average once per year. Remember, I don't know if you remember this, we had a correction in October of last year. Stocks fell over 10%. And they came right back. Corrections are a normal part of investing. And I have a slide to show you this a little bit later, but corrections are a normal part of investing. We do think a pullback is likely, maybe who knows, maybe 5%, 6% pullback, or a correction is possible, 10% or more. And that's sort of our second perspective. But don't hang up on me right now, because let's talk about our third section. And our third section is any pullback, any correction, any weakness should be short-lived, because there's lots of good news from our foundational standpoint. So let me talk about this. Why? So first of all, you've got the fact that we don't see a recession in the next 12 months. Second of all, we still think the Fed will cut rates this year. Third of all, look at this slide. And this slide shows bars, and these bars are earnings growth from major asset classes. So I know that's complicated, but let's look at like 2025. No, sorry. Look at 2024. See that 11.1%, the big purple bar sort of near to the left? That says that the estimate for earnings for this year for the stock market is 11.1%. That's great news, because in the world of investing, what this means is that earnings drive stock prices. So remember the analogy I gave before? If a company sells more stuff, they generate more earnings. If they generate more earnings, this suggests that their share price moves higher, and investors tend to buy the shares of those companies. There's some assumptions in there, but basically earnings drive stock prices. Companies and investors like earnings growth being higher. So this year, it's expected to be 11.1%. Next year, 13.5%. Good news. We think earnings are going to be pretty strong. Another thing to look at is that there's a lot of cash on the sideline. There's a lot of cash waiting to come in the market. If you look at this chart, this is the combined savings in both money market assets and bank deposits. There's $24 trillion sitting on the sideline that could come into the stock market. And if you think about the stock market, the US stock market has a total market capitalization of about $50 trillion. It's pretty big. But even if a little bit of this comes in, like let's say we have a pullback and a little bit comes into the market like we saw back in October, this is really good for the market. So again, the whole gist of this is that basically we do expect a pullback. We do expect some weakness near term, but any weakness, any pullback should be pretty short-lived, because there's some really good, strong foundations. Plus, again, we don't see a recession and we see the Fed cutting rates. So with that said, what do you do? How do you take advantage of what I just talked about? And there's two things you got to do. Number one is you need to be diversified. And when we have these periods where everyone's buying technology or AI or growth stocks, like we saw back in like 1999, what happens is that we say, okay, growth is the best thing since sliced bread. We forget about everything else. That's not the proper way to invest. The proper way to invest is to be diversified, have some exposure to different parts of the market, some stocks, some bonds, some small caps, some large caps, some exposure to different parts of the market, because historically this has shown that it smooths out the long-term return and gives you exposure to different parts of the market. Plus, you just look at this chart. Remember we talked about PE ratios, price to earnings ratio? Look at that dark purple line on the top. That's large cap growth. That's like these big growth companies. Right now, the PE ratio is around 35. Look at the rest of the market, like value stocks, non-US stocks. They're trading around 15 or so from a PE ratio, a lot cheaper than those large growth stocks. Again, so growth stocks are really good investments, but having some exposure to other parts of the market is very important. Diversification is key. And one more point about diversification. Why is it so important? Look at this chart, and this is one of my last charts. This chart shows the stock market, the S&P 500, year by year by year. So each of those bars is the stock market, is the S&P 500. What we've seen is that in the last 44 years, the stock market has been positive in 36 of the last 44 years. So what that means is that the stock market has an upward bias. So up 36 of the last 44 years. But more importantly, see those little rectangles, those maroon rectangles? Those are intra-year losses. That's those downside, the sell-offs, those corrections, those weaknesses that occur almost every single year. So despite the fact the stock market is up, 36 of the last 44 years, the average intra-year loss, the weakness, the downside, the drawdown, whatever you want to call it, is negative 14.2%. So what that means is that volatility, fluctuations, intra-year weaknesses are a normal part of investing. This is why you want to be diversified. You want to have exposure to different parts of the market to smooth out the return. So again, my first thing to say to you is, number one, be diversified. Number two, how do you be diversified? What's appropriate, what's not appropriate? Be in contact with Lindsey and her team, because they need to make sure that your portfolio is not too aggressive, it's not too conservative relative to your long-term objectives. They need to make sure that you are appropriately invested. You don't want to be too aggressive, you don't want to be too conservative. So if there's any changes to your lifestyle, family, job, whatever it is, be in contact with them, call them, text them, page them if you want. If you still have a pager, page them. Reach out to them, because you need to make sure that they are understanding your financial situation constantly. So before I wind on, we've been getting a lot of questions lately. I kind of want to address two questions. So one of the questions I've been getting a lot from a lot of clients like you is, hey, the Baltimore, harbor, the impact, the ship crashing into the bridge, what does this mean to our economy? And we take a step back. First of all, our hearts and prayers go out to those affected by the tragedy. It's a terrible tragedy, terrible loss of life when the ship crashed into the bridge. Really, really sad. But from an economic standpoint, what does this mean? We really think it should have a very minimal effect on the U.S. economy, because the Baltimore port is the 15th largest in the United States. So it's fairly small. It only represents about 1.5% of U.S. imports. And so the other ports around can definitely take the additional imports in. And Baltimore primarily imports cars, auto parts. And if this happened during COVID or happened during when there was a shortage of cars, we'd be worried. But if you look at this chart, see on the right-hand side, auto inventories have been increasing dramatically. So we aren't too worried about the impact on our economy, because again, it's primarily cars and auto parts being imported in the Baltimore port. Another question I get from a lot of you is, hey, we have an election this year. What does this mean to the stock market? And it's going to be the most ho-hum answer that you hear today, but it means absolutely nothing. Seriously. If you look at this chart, this is since 1960. In the election year since 1960, the S&P 500 has returned on average 10.5% on average, regardless of who wins, Democrat, Republican, challenger, incumbent. Average is 10.5%. And in those years where the stock market, in those election years, we've only had two down years. 2000, that was also the Y2K and tech bubble crash. And in 2008, we had the whole great financial crisis. Generally speaking, the stock market does not care about elections at all. And anecdotally, think about this. Think about the last few elections. Stocks rallied on a red wave. Stocks rallied on a blue wave. Stocks rallied on the mixed government. At the end of the day, the stock market doesn't care. Stock market really views it as a non-event. So don't use the election to dictate how you invest or get out of the market. So please don't. Again, I just want to thank you. And listen, again, our themes are, lots of good news. The economy looks great. Inflation is slowing down. The Fed will cut rates, in our opinion. There's lots of enthusiasm in the market today, but we think there's too much enthusiasm. There's too much, everyone saying only good news. We do think there'll be a pullback. So don't worry, because even if we have a pullback, the fundamentals are so strong in the economy and the stock market, we do think it'll be very short-lived. And if you do want to follow us, my team and I, Cetera IM, and then if you want to follow me, it's Gene Goldman. Listen, one point, my mom and I have a New Year's resolution. I want to have more Twitter followers than my mom. My mom has more Twitter followers than I. And at holiday dinners, it's really tough because she makes fun of me constantly. So please follow me if you can. It's hard to compete with my mom. She tweets about scores for New England Patriots games. She tweets about animals that need to be rescued and some anti-politics stuff you don't want to read. But at the end of the day, it's hard to compete with her. So with that said, I want to thank you, and I'll stop sharing my screen.
Great. Well, thanks, Gene. A lot of information. Appreciate your, as I said, enthusiasm, and then the, the data that supports some of these points that you're trying to make. What's backing it up. So I think that's really helpful for clients to see. So that balance of there is a lot of good news, and we are feeling like we're through some of that recessionary concern, but that it might not be exactly a smooth ride this year, as we're still working through some higher valuations and other things that logically we can look at and see, and just know that we can't continue to be kind of on that upward trend that we're seeing since October of last year. One thing we didn't touch on, and I'm just curious because it's something is out there and hear a lot about too, is kind of some of the valuations that we're seeing in commodities. So gold, right? That's always been something that's been tied to inflationary time periods and things like that. Do you have any comments that you would make around that specifically?
Gold, I think the bigger one is chocolate. Cocoa is up like yearly, it's like 150%. So gold, obviously people are buying gold. They buy gold in times of uncertainty, in times of inflation. Historically, we learned this in the 70s and the 80s when there's inflation, gold surges. I do worry about it a little bit because let's say that there's bad news and gold, people think of gold as a safe haven. So what they do is they buy gold. But if there's bad news, what you tend to see is the dollar rallies during bad news. And if dollar rallies during bad news, because gold is priced in dollars, it tends to weaken. So I'd be a little leery about that. I mean, it's okay to have some commodities, some exposure there. I would look instead, keeping it simple, stocks, bonds, allocations, and stocks and bonds. Another way to be safe in the market is to buy bonds, and bonds are safe and they tend to reduce that volatility. So I would look at that. Having some commodity is great, but it's a very dangerous game because there's something called contango where we can spend hours talking about the futures market and contango, but basically as these contracts get rolled over into the next month, it reduces the value of these commodities, and it's not the best thing to do. So I would suggest, you could have some gold stocks in your portfolio, maybe. You also have treasuries, but at the end of the day, have a little bit, but don't be too crazy in terms of the allocation.
That's great. And then when we, segue into bonds, I know that there's, this conversation about higher rates for longer. So from the, research side of things, has Cetera started to think about adding duration to bonds, or are they still sticking with more short-term treasuries?
Sure. Great question. And so we all know on the same page. So duration means interest rate sensitivity. So we can spend another class on bond investing 101, but the longer the maturity, the longer the bond, like a 2-year treasury versus a 10-year treasury, a 10-year treasury bond, because it's a longer maturity, and there's other reasons, but basically it has a higher duration. And what duration means is that a 1% rise in interest rates, bond prices fall based on the value of the duration. So let's say that I have a bond that's a duration of 6. If interest rates move 1% higher, the bond will fall by 6%. If interest rates fall 1%, the bond should move up by 6%. So keep that in mind. Interest rate sensitivity. We are very aggressive. We've aggressively been increasing our duration, our interest rate sensitivity in our portfolios. We think that, let's say the 10-year treasury around 4.60 or so, 4.60%. We think it's extremely attractive right now, these yields, because let's say this, the 10-year treasury yield trades with a yield of about 2.25 over inflation. That is pretty attractive. That's basically, you're saying you're getting the yield of inflation, you're getting the return of inflation plus an additional 2%, 2.5% with less risk. it's pretty attractive right now. So this is why we've been increasing duration with our portfolios. Plus, we think we're near the top, closer to the top of rate. I mean, we're closer to the top of the rates than we were before. So we do think yields are going to come back down, especially as the economy slows down, doesn't recessionize, but slows down a bit. So we would be buying bond yields. We think bonds are really attractive. High quality, high yield worries us, but high quality are really good.
Great. I really like just, when we started this conversation, that whole idea that, Goldilocks economy. I think that's something that we can probably all take away with us today, that, there's things that are, that we're working through, but it's all headed in the right direction. So we've answered all the questions that have come up. I was taking notes as you went through with questions that were popping up, and then what do you know? You actually hit on it and answered it, such as the election and some of the other things. So yeah, clearly you do this, all the time, and know what's on people's minds. So we won't take up too much more of your time, but just wanted to really thank you for the expertise that you brought to us today, and really that high level of what is going on. Because I think that that's one of the things as investors, it's hard to get to the root of that, and then just even when, depending on what you're hearing, seeing, listening, it's changing so quickly day to day what that narrative is. So being able to dig a little deeper and understand some of those fundamentals that are beyond what I'll refer to as the noise of the media sometimes, it can be really helpful to our clients.
Thank you, and it's wonderful to work with you and your clients. It's just, you guys are so wonderful. So thank you.
Yeah, great. Well, thank you, Dean, and thank you everyone for joining us today. And we'll look forward to see what the next quarter brings.
Great. Thank you.
All right. Have a great day. Bye-bye.